Jim, what kind of scenarios do you have in a base case now?
Well, I think we have to go from the top down, right? Because these are very interesting times. So when we think about the global economy, we think about it as being bent but not broken. And there are some key thresholds here where we can see maybe where the breaking points might be. The first one we have to start with is world growth, right? World growth we would expect over the next 4 quarters to be at about 2.7%.
Yeah.
That is danger
not
close.
Great. Yeah.
Correct. That is danger close to the recession threshold, which is about 2.5%. Next, we've got to go to Europe. Germany, if we have another quarter of negative growth, we're going to be in a technical recession. Then we have to move over towards China. China's growing at about 6 to 6.2%.
If you believe the numbers.
If you believe the numbers. If they start to fall below 5.8% growth, that to me tells me that it's going to be harder for them to have net contributions to jobs, and there'll be net subtractions, and now all of a sudden you're going to see a contracting labor market in China.
Meaning what exactly?
Which means that conditions start to get worse a lot faster in China, which means global growth.
So you're watching for all of these to break to the downside?
Watching for all these right now to break to the downside because that's the direction of travel. The next is the U.S., and this is where we start to think about the Fed. Right now, the second half growth for the U.S. probably between 1% and 2% growth. Now that would put 2019 growth probably somewhere around 2%, just under 2% growth. Now, that's not terrible.
Right.
However, when we start to think about the Fed probably starts to need to get ahead of this.
But that's where it gets really interesting. And I want to read something that Tom Simons at Jefferies wrote today. He was specifically saying that the Fed is falling behind the curve. He said the Fed waited to see the after effects of Lehman go under before they decided to step in. And we all know how that worked out. He cited Greenspan, saying Greenspan cut and hiked again. This Fed can easily do the same this time around. So if they cut now, they can hike again once Trump ends the trade war. He says the only thing holding back the Fed from cutting is pride. So I raise that because you also think they should be more aggressive in a world where we're talking about U.S. looking okay, and the data this morning confirming that once again.
Right, and think about all the things I just listed in terms of thresholds. The Fed needs to get ahead of this. They need to be more aggressive. They need to be proactive. It's the world's largest central bank. They need to lead, not follow.
Okay, but the only thing, Michelle, that we might have learned today is that because in all of those scenarios, they could work out to the upside as well.
Sure.
The main thing seems for everybody to come down to what's going to happen with the U.S. and China. And you're suggesting maybe the new information there is negative.
So I find this obsession with the trade deal by the markets interesting. I think the far more consequential question in the world is, why are yields going so low? As he points out, right? I mean, there's something going on here. Is it solely because of the trade war? I don't believe it. The trade war likely exacerbates it.
Right.
Yes, for sure. But there's something much bigger at play. What is it, and what is the problem?